Let's go ahead and go through that long example of intercompany inventory sales with multiple subsidiaries. Okay, so big company owns 70% of little company and 80% of mini company. Big uses the partial equity method, and we have information on intercompany sales merchandise for 2020 and 2021. 2020 was the first year of these intercompany sales. Again, the question is provide elimination entries arising from these intercompany transactions for 2020, 2021, and 2022. Also, assuming that little and mini each reported earnings of $100,000 per year each year, determine the income to the non-controlling interest in each of those years. Okay, so first, 2020, Big's sales to Little. Again, the first entry, we're going to go and eliminate sales and cost of goods sold in the amount of the intercompany sales. Next, looking at that top line in the table, we see that there was a $20,000 gross profit, sales price less cost. 60% of the merchandise was resold in 2020. That means 40% was not. So 40% of that $20,000 profit, or $8,000, is unrealized. We're going to go ahead and defer that by increasing cost of goods sold by $8,000 and adjusting our inventory downwards to essentially strip out that markup or strip out that inflation of the inventory value. Okay, similarly for the sales from little to mini, first thing we're going to go ahead and do is eliminate the sales and cost of goods sold for little's intercompany sales of $50,000. Secondly, we see that in 2020, Little had a $15,000 gross profit, $50,000 minus $35,000, second line on the table. Of that $15,000 gross profit, 80% was realized. The other 20%, or $3,000, was unrealized because the merchandise has not been resold yet. So we need to defer that $3,000 gain, and we're going to do that by increasing cost of goods sold and again decreasing inventory. The income to the non-controlling interest, again, in the case of little company, the non-controlling shareholders own 30%, so they're going to get 30%. We multiply that by the reported earnings, plus or minus any adjustments to income from this. And again, that first elimination entry is a wash. Revenues and expenses both drop by $50,000. The second elimination entry, we have a $3,000 debit to cost of goods sold. That reduces earnings, so 30% of $97,000, or $29,100. Finally, we have the sales from mini to the related party, and again, first step is to eliminate the sales revenue and cost of goods sold for the intercompany sales price of $60,000. Secondly, we go ahead and look at the third line of that table. We see that mini had a $15,000 gross profit, sales of $60,000 less cost of goods sold of $45,000. So a $15,000 gross profit, 70% of that was realized, the other 30% is unrealized, so we need to defer 30% of $15,000 or $4,500, and again we do that by increasing cost of goods sold and decreasing inventory. Finally, the income to the non-controlling shareholders, 20%, the non-controlling shareholders' ownership of mini company, multiplied by the adjusted / realized earnings from mini, $100,000 reported minus that $4,500 debit to cost of goods sold, or $19,100. Okay, moving on to 2021. We're going to start with Big's sales, and again, notice that I've moved away from saying Big selling to mini or Big selling to little. All that's really relevant is that Big is the company that's making the sales. It doesn't matter whether they're being sold to little or to mini. Big is the seller. Big, so this is a downstream sale. The unrealized or realized gross profit is on Big's income statement. It doesn't matter which of the related parties bought the merchandise. So in any event, we're going to go ahead and eliminate sales and cost of goods sold of the amount of the intercompany sales revenue. We see that Big Company has a $20,000 gross profit, 90% of which has been realized, the other 10% of which is not realized. So we need to go ahead and defer $2,000 of unrealized gross profit by again increasing cost of goods sold and decreasing inventory. And then finally, we have to carry forward the unrealized profit from the previous year. So again, let's go ahead and refer back to that 2020 line. In 2020, Big had a $20,000 gross profit, 60% or $12,000 of which was realized, $4,000 of which was deferred. So we're carrying forward a $4,000 unrealized gross profit. This was a downstream sale, so the non-controlling interest is not involved. Big uses the partial equity method, so they're going to go ahead and debit retained earnings. Now, big sales of that $8,000 that was deferred, look at the pattern of merchandise being resold in that first line of the 2020, the first line of that table. Of the 40% that was unsold at the end of 2020, 30% or 3/4 was resold in 2021. The other 10% or 1/4 was resold in 2022. So of that $8,000, 3/4 or $6,000 has now been realized. We're going to go ahead and credit cost of goods sold for $6,000 to realize that. The other $2,000 is still unrealized. So the purchasing company, Little, still has some merchandise on their balance sheet from 2020, which is carried at a $2,000 markup. So we're going to go ahead and reduce that down to its correct historical cost. Okay, 2022, Little's sales. Again, eliminating sales and cost of goods sold in the amount of the intercompany sales revenue. Little company in 2021 has a $10,000 gross profit, 20% of which, or $2,000, is unrealized. And now we need to carry forward the unrealized profit from the previous year. Again, looking at line 2 of that table, we can look back to our entries that you've done in the previous year. In 2020, there was a $15,000 gross profit, 20% of which, or $3,000 of which, was unrealized. That has now all been realized because the remaining merchandise was sold in 2021. So $3,000 was an upstream transaction, so that $3,000 is going to be split 70-30 between the parent and the non-controlling interest. Again, what's relevant is that Little is a 70% owned subsidiary, so the non-controlling interest is going to get 30% of that $3,000, and that $3,000 has all now been realized. Finally, for Mini's sales, again, we eliminate the intercompany sales revenue and cost of goods sold for $140,000. Secondly, we see that there's a $40,000 gross profit for Mini in 2021. 40% of that, or $16,000, has been realized. The other 60%, or $24,000, is still unrealized. So we have to go ahead and defer $24,000 as the unrealized gross profit. Finally, we carry forward the unrealized profit from the previous year. And again, looking at that third line, what happened back in 2020 with Mini's sales? There was a $15,000 gross profit, 30% of which was deferred, $4,500, and now none of that merchandise was resold in the current year, 2021. So none of it is being realized this year. It's all going to be treated as, is continuing to be carried forward as an unrealized profit. So we carry forward our $4,500. We're going to split that 80-20 because, again, Mini is an 80% owned subsidiary, so the non-controlling interest gets 20% of that $4,500, and that entire $4,500 is all an adjustment to our inventory account. Okay, finally, let's go ahead and do the income to the non-controlling interest for Little and Mini. In the case of Little, it's a 70% owned subsidiary, so the non-controlling shareholders get 30% of the adjusted/realized earnings. So we start with the reported earnings of $100,000. We look at those elimination entries and say the second elimination entry has a $2,000 reduction of income. The third elimination entry has a $3,000 increased income. So 30% of $101,000 is $30,300. Likewise, for Mini Company is an 80% owned subsidiary, so the non-controlling shareholders get 20% of the adjusted/realized earnings. Again, we start with reported earnings of $100,000. We look at those elimination entries. The only one that has a net effect on income is the second, with a $24,000 debit to cost of goods sold. So that reduces the realized earnings to $76,000, 20% of which is $15,200. Now, before we go any further, let's see how unrealized profits are going to be carrying forward to the next year. First, looking at BIG's information for 2021. We had 2 batches of unrealized gross profit that were being carried forward. We had $2,000 that had been deferred from 2021, And there was still also $2,000 that was still being deferred from 2020. So we're carrying forward $4,000 of unrealized gross profit, and there were no intercompany sales in 2022, which is where we are now. But we do have to worry about carrying forward this $4,000 of unrealized gross profit. And again, if you look at the information for BIG's sales up in the tables, you see that the 2020 sales in the first line, the last 10% of that merchandise is going to be resold in 2022. So the $2,000 in that third entry in the big column, that's all going to be realized because the merchandise has finally been sold. Looking at the 2021 line for BIG's sales to Little, we see that also of the merchandise that was sold in 2021, the remaining 10% is going to be sold in 2022. So basically all $4,000 of that previously unrealized gross profit is now going to be realized. Okay, we have to do the exact same thing for mini sales. Now looking at little sales, there's only one group of deferred gross profit being carried forward from that second entry. In the case of mini, however, we're carrying forward two batches or two layers of unrealized gross profit. That first one for $24,000. Again, in 2021, Mini had a $40,000 gross profit on their sales, 40% of which was realized, 60% of which was unrealized. We're carrying forward $24,000 from our 2021 sales. In addition, the $4,500 in the last entry, that's the 30% of the $15,000 gross profit in 2020 that's still being carried forward. And again, just as was the case with Big, say, look, of that $24,000 being carried forward from 2021, again, look at the 2021 mini sales. 40% sold in 2021, 30% sold in 2022. The other 30%, well, that's going to be apparently sold some point 2023 or beyond. What matters is that of that $24,000, half of that is now being sold in 2022 and will be realized. The other half is still unsold and will be carried forward. The stuff being carried forward from 2020, all of the remaining merchandise from 2020 is being sold to a third party in 2022, so the entire $4,500 is going to be realized. Okay, so let's go ahead and do our 2022 elimination entries. And again, there are no intercompany sales for 2022, so entries number 1 and 2 essentially are blank. We carry forward the $4,000 from the previous year, and that's all being realized. Likewise with Little's sales, we were carrying forward $2,000 from the previous year. That was in upstream sales, was being split 70-30 between the parent and the non-controlling interest, and all of that merchandise had been sold. Finally, in the case of Mini, we're carrying forward $28,500. Again, $24,000 being carried forward from 2021, $4,500 being carried forward from 2020. Most of that is now being realized. All of the deferred gross profit from 2020 plus half of the $24,000 gross profit from 2021. The remaining $12,000, the credit to inventory, that's being carried forward from 2021 forward into 2023.